Hi, this is Stephen here from Share Navigator with an update on the markets and how the S&P 500 and some of the broader market indices are moving along. So you can see this was kind of our flash crash, if you like, over the last few weeks, and we reached a low here of about 253, I think it was. And then we've been steadily rising ever since. And a lot of you felt that the opportunity was lost for some option premium selling, etc., like that. And in my view, it's not. And I'm going to share the reasons why. So, first of all, we explained before, and I'm not going to go through that again. We feel that fair value for this market this year is about 260, and then next year could be up as high as 290. So we feel that's going to be the trading range for the next 12 to 18 months, and thereafter, depending on where interest rates are at, um, we could be heading south, and that could be the end of the bull run in our view. Um, if interest rates remain low and the economy isn't forecast to tip over, we could go a little bit higher. But based on current earnings forecasts and interest rates at the moment, we feel that the premium that was previously priced into the market is going to go, and markets will retract back to more reasonable and multiples of earnings and of sales. And therefore, what we see is that market trading between 260 and 290 over the next 12 to 18 months. So, what we've had is this flash crash, a big 10 to 15% correction in a very short period of time, and then the markets were kind of steadily rising. So, my own view is we're going to probably go sideways for a period of time. I do think that these lows could be tested again and even go lower. And then, as I said, we'll trade somewhere between 260 and 290 for the next 12 to 18 months. But right now, some money may continue to come off the table. But I don't think this is a worry for people who are in long positions who are considering selling all of their positions. I'm not sure I would buy into that, especially if you've got high dividend paying stocks there. I do think the fundamentals of the stocks are very, very strong, and therefore I wouldn't be in a panic to sell my positions. Having said that, I wouldn't be a buyer at these levels either. So what are we going to do? Again, we think as the market falls towards that 260 level, if you have a big enough account, you could be writing puts under the 250 level. So anywhere, if you have an average price into the S&P 500, assume that you're going to be assigned the shares. Selling puts in between 240 and 250, or having an average price in that level, is quite a good entry point in our view. And then our view would be to try and exit then if you were assigned the shares at 280, 290. For those of you who've got smaller accounts, there is another way for you to play that. You could actually just go and buy the SPY ETF. If it drops down to these lows again, wait for a turn in the market. And if I'm correct and this market starts going sideways, you can actually make an awful lot of money. In fact, in the early days of my trading, I used to make more money in sideways trending stocks than any other type of trading that I ever did. And that's what because they went into these predictable patterns. And I do feel the S&P 500 is setting up to go that way. If you think about it, interest rates are going out, bond yields are going out. Yes, fundamentals are strong, but investors mightn't be as confident anymore when the market reaches a high to kind of keep pushing it higher. So you may see some selling coming into it. And then on the flip side of that, with earnings being so strong, when the market pulls back, investors don't want to miss out. So they may want to start accumulating a bit. And I think that's going to give us a sideways trending action in the market. And in that way, you can actually buy and sell between particular points. So for example, if you felt 260 was the low, you wait for a turn in the market, you buy the S&PY at 260, and maybe you sell it at 270. You're making a 10-point gain on that. So it doesn't sound like an awful lot, but that can be quite significant over a period of time. If you keep adding that up over a period of time, it could be, it's less than a 0.5%, but you could be doing that once every week or once every 2 weeks. So I really think this is where the market is going to end up. I don't think we're going to get below that 240 level. Having said that, if there's a geopolitical event, we could go down there. If interest rates spike, we could go down there. But I do feel that the best you can hope for is to get an average price in that 240 to 250 level. And then I think it's a good opportunity to start entering the market again. Bond yields have kind of calmed down. They're settling in and around that 2.9% on the 10 year at the moment. So um, I just feel it's all set up here for sideways trending motion until we start getting more and more earnings reports throughout the year. If earnings are raised higher, we could go a little bit higher. But for right now, based on fundamentals, 260 to 290 is the target. So I'd be looking to take positions in below that 250 mark if I could. If not, you could do what I said, is just to roll the stock by buying it maybe at 255, 260, selling out at 270, 280, and just keep doing that. Okay, this is Stephen from Share Navigator with the update on the S&P 500. Thanks and bye for now.